Focus on business English. The charts mentioned in this episode can be found in the transcript on our app. Bull versus bear market. What's the difference? Levels, intermediate up. A bull market is occurring when the economy is expanding and the stock market is gaining value, while a bear market is in effect when the economy is shrinking. Let's take a closer look at these two types of markets and their relevance for your investing strategy. What is a bull market? According to the formal definition, a bull market takes effect when stock prices have broadly increased by at least 20% since the last market downturn. Bull market conditions can last for decades, and many successful investors have bet very wrongly by trying to predict the end of a bull market. The U.S. stock market was in a bullish mode after recovering from the 2008 financial crisis until pandemic-related uncertainty caused a market crash in 2020. The chart below shows that, aside from minor market corrections, a bull market persisted for more than a decade. What is a bear market? A bear market is defined as starting when stock prices broadly decline by 20% and keep trending lower. Bear markets are characterized by people losing their jobs, gross domestic product or GDP declining, and the stock market losing significant value. Bear markets almost never last as long as bull markets and can create buying opportunities for investors. The most recent bear market began following the crash of the housing market in 2008, as made apparent by the chart below. How do bull markets and bear markets differ? If you want to know whether a bull or bear market is in effect, pay attention to these factors. Number 1. Stock market performance. Stock prices are rising in the bull market and declining in the bear market. The stock market under bullish conditions is consistently gaining value, even with some brief market corrections. The stock market under bearish conditions is losing value or holding steady at depressed prices. Number 2. Change in GDP. Rising GDP denotes a bull market, while falling GDP correlates with bear markets. GDP increases when companies' revenues are increasing and employee pay is rising, which enables increased consumer spending. GDP decreases when company sales are sluggish and wages are stagnant or declining. Bear markets are closely linked with economic recessions and depressions. Recessions are formally declared when GDP decreases for 2 consecutive quarters, while depressions occur when GDP decreases by 10% or more and the downturn lasts for at least 2 years. Number 3. Unemployment rate changes. A declining unemployment rate is consistent with a bull market, while a rising unemployment rate occurs during bear markets. During bull markets, businesses are expanding and hiring, but they may be forced to lower their headcounts during bear markets. A rising unemployment rate tends to prolong a bear market since fewer people earning wages results in reduced revenues for many companies. Number 4. Rate of inflation. Price inflation may be a problem when the economy is booming, although inflation during a bear market can still occur. High demand for products and services in bull markets can cause prices to rise, and shrinking demand in bear markets can trigger deflation. Number 5. Prevailing interest rates. Low interest rates typically accompany bull markets, while high interest rates are associated with bear markets. Low interest rates make it more affordable for businesses to borrow money and grow, while high interest rates tend to slow companies' expansions. How should you invest in a bull versus bear market? Growth stocks in bull markets tend to perform well, while value stocks are usually better buys in bear markets. Value stocks are generally less popular in bull markets based on the perception that, when the economy is growing, undervalued stocks must be cheap for a reason. What is a growth stock? Growth stocks are companies that increase their revenue and earnings at a faster rate than the average business in their industry or the market as a whole. A growth stock is a stock in a company expected to deliver above-average returns compared to its industry peers or the overall stock market. Growth investing, however, involves more than picking stocks that are going up. Often, a growth company has developed an innovative product or service that is gaining share in existing markets, entering new markets, or even creating entirely new industries. Businesses that can grow faster than average for long periods tend to be rewarded by the market, delivering handsome returns to shareholders in the process. And the faster they grow, the bigger the returns can be. Despite their premium price tags, the best growth stocks can still deliver fortune-creating returns to investors as they fulfill their awesome growth potential. What are value stocks? Generally speaking, a value stock trades for a price that's cheaper than its financial performance and fundamentals suggest that it's worth. Some stocks have both attributes or fit in with average valuations or growth rates. So whether to call them value stocks depends on how many characteristics of such stocks they have. Value stocks generally have the following characteristics. They typically are mature businesses, steady but not spectacular growth rates, relatively stable revenues and earnings. Most value stocks pay dividends, although this isn't a set-in-stone rule. How you invest in stocks in bull and bear markets depends mainly on your time horizon. If you do not need the money for decades, then it matters little whether the market is currently bullish or bearish. As a buy and hold investor, you probably shouldn't change your investing strategy based on prevailing market conditions. The stock market can be bearish even while bull markets are occurring in other asset classes and vice versa. If the stock market is bullish and you're concerned about price inflation, then allocating a portion of your portfolio to gold or real estate may be a smart choice. If the stock market is bearish, then you can consider increasing your portfolio's allocation to bonds or even converting a portion of your portfolio into cash. You can also consider geographically diversifying your holdings to benefit from bull markets occurring in other regions of the world. Regardless of the current state of the stock market, it's important to stay focused on the long-term prospects of the companies in which you are invested. Companies with great business fundamentals are likely to produce significant returns for your portfolio over time.